Would you like to invest in a company that can practically guarantee business, looking to get a profitable piece of space, the final frontier? Want to collect a market-beating dividend that's growing at a double-digit rate? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel. I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a prime defense contractor that takes in more than $30 billion in annual revenue. Defense contractors operate one of the most attractive business models I know of. The defense industry practically guarantees business. Sovereign entities really can't exist without defense products and services. And this is an oligopoly we're talking about, with only a few entrenched players competing against one another. That means lots of profit and dividends for shareholders benefiting from these dynamics. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Northrop Grumman Corporation, which appear to be trading at a significant discount today. Northrop Grumman Corporation, stock ticker NOC, is a large defense contractor that manufactures and provides a range of sovereign defense products and services. Founded in 1939, Northrop Grumman is now a $50 billion by market cap global defense juggernaut that employs 90,000 people. Fiscal year 2019 revenue breaks down across the following segments: aeronautics systems 32%, mission systems 26%, space systems 22%, and defense systems 20%. Approximately 83% of sales are to the US government, mostly via the Department of Defense. While they have large conventional military programs like the B-2 Spirit, a lot of Northrop Grumman's work is based around unmanned combat like radar, drones, and strategic turret systems. The company is also making strides in space with the $9.2 billion acquisition of Orbital ATK in 2018, greatly boosting their space capability. High-quality defense contractors like Northrop Grumman can make for excellent long-term investments. These companies produce high-tech, long-cycle, expensive, classified products and services that are absolutely vital to sovereign security. Business is about as guaranteed as it gets. Plus, this industry operates as an oligopoly, which limits competition and promotes rational pricing. And due to unique dynamics, it's extremely difficult for new entrants to spring up. That bodes well for increasing profit and dividends over the long run. Northrop Grumman has already increased its dividend for 17 consecutive years. The 10-year dividend growth rate of 12.9% is really strong when you pair that with the stock's current yield of 1.9%. This yield, by the way, beats the market and is 30 basis points higher than the stock's own 5-year average yield. The payout ratio is only 39.5%, which easily covers the dividend. We have a lower yielding, faster growing dividend here. That's perfect for younger investors who have time to let the dividend blossom into a real monster. Looking at business growth, Northrop Grumman's revenue decreased from $34.757 billion in fiscal year 2010 to $33.841 billion in fiscal year 2019. A slight decrease in revenue over a 10-year time frame is not what I typically like to see. However, this decrease is mostly owed to Northrop Grumman's spin-off of Huntington Ingalls Industries Inc. in 2011. This move substantially reduced Northrop Grumman's revenue base at the time. Meantime, the company's bottom line has grown very nicely over the last decade. Earnings per share moved up from $6.82 to $13.22 over this period, which is a compound annual growth rate of 7.63%. Material buybacks have definitely helped. The outstanding share count is down by almost 44% over this 10-year period. Looking forward, CFRA is projecting that Northrop Grumman will compound its earnings per share at an annual rate of 10% over the next 3 years. CFRA is anticipating a nice acceleration in growth. They cite improving margins, their alignment with the Department of Defense's high priority around space-based assets, higher product volume, valuable exposure to the F-35 program, and a record backlog of over $81 billion, which is up 25% year over year in the third quarter of fiscal year 2020. It's heartening to see this kind of forecast, but even if the company falls slightly short, the low payout ratio gives them the ability to continue growing the dividend at a double-digit rate for the foreseeable future. There is powerful long-term dividend growth potential here. Moving over to the balance sheet, the company maintains a good financial position. I think this is one area of the business that could stand improvement. That said, it's not bad. The long-term debt-to-equity ratio is 1.45, while the interest coverage ratio is just over 6. Profitability, meanwhile, is quite robust. Over the last 5 years, the firm has averaged annual net margin of 8.63% and annual return on equity of 34.06%. These numbers are comparable to the industry's best. This is a great business, and they're protected by durable competitive advantages, including classified knowledge, huge scale, barriers to entry, long-term contract, technological know-how, and high switching costs. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The industry oligopoly limits competition. However, direct government oversight increases regulation. Geopolitical risks are present for any defense contractor. U.S. President-elect Joe Biden is a Democrat. A Democratic administration may put pressure on U.S. defense spending. The company has a lot of space exposure. While this is exciting, it's also a new frontier that has not yet proven itself to provide durable demand for defense products and services. Even with these risks, I still believe an investment in Northrop Grumman will do very well over the long term, and I think the current valuation of the stock sets it up especially well. The stock is available for a price-to-earnings ratio of 20.7. That looks slightly high at first glance, but it's being elevated by a hit to the fourth quarter fiscal year 2019 GAAP earnings per share from a pension adjustment. Factoring that out, the PE ratio is well below both the broader market and the stock's own 5-year average PE ratio. Consider that the price to cash flow ratio is only 9.8, which is much lower than the stock's own 3-year average price to cash flow ratio of 17.6. And the yield, as noted earlier, is notably higher than its recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is on the higher end of what I allow for, but I think this business deserves the benefit of the doubt. Keep in mind, the company has exceeded this 8% rate with its long-term dividend growth. The 10-year earnings per share growth rate is almost at this level, and CFRA's near-term earnings per share growth rate projection is well in excess of this mark. With the company's positioning in both traditional military programs and new age tech-heavy areas, the growth engine is showing no signs of slowing. The dividend discount model analysis gives me a fair value of $313.20. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Northrop Grumman as a 4-star stock with a fair value estimate of $338. CFRA rates Northrop Grumman as a 5-star strong buy with a 12-month target price of $450. I came out low this time around. Averaging the three numbers out gives us a final valuation of $367.07, which would indicate the stock is possibly 21% undervalued. Here's the bottom line, guys. Northrop Grumman Corporation is a high-quality defense contractor that is positioned well for both current and future sovereign defense needs. With a market-beating dividend, almost 20 consecutive years of dividend raises, double-digit long-term dividend growth, a very low payout ratio, and the potential that shares are 21% undervalued, this looks like a great long-term opportunity for dividend growth investors. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.